Your car insurance bill isn't just high, it's breaking records. In 2026, drivers everywhere are paying more than ever before. Some saw their premiums jump by 20%, others by 50%, and a few even doubled overnight. And it is not just bad luck, it is a system that is changing fast. With new technology, expensive repairs, and corporate strategies pushing prices higher every year. Today, we're breaking down why car insurance is exploding in 2026, and more importantly, what you can actually do to protect yourself. Welcome to Car Hacks and Money, the channel that helps you save money every mile. Here, we break down the real costs of owning a car, what dealerships, automakers, and insurance companies don't want you to know. So if you've been noticed your insurance bill going up even though you haven't, changed cars, made a claim, or had an accident, this video will show you exactly why it's happening and how to fight back. Let's start with the numbers, because they tell the real story. In 2020, the average American paid around $1,500 a year for car insurance. And here's the scary part, most people didn't get into accidents, file claims, or change their coverage. Their premiums went up automatically, with little explanation. Insurance companies blame inflation, car technology, and repair costs. But the truth is more complicated, and it starts with how the modern car has changed. There isn't one single cause. It's a mix of economic pressure, expensive technology, and shifting corporate strategies. Cars today are smarter than ever, with sensors, cameras, radar, and touchscreens in almost every model. But those smart features come with repair bills that are anything but smart for your wallet. A simple bumper replacement that used to cost $400 can now cost $2,000, just because it includes embedded parking sensors or radar for driver assistance. A cracked windshield on a new AV or hybrid can cost over $1,200 to replace because it requires camera recalibration. Insurance companies are factoring that into every policy. They know that one minor accident now costs them more than ever, so they raise premiums across the board. Electric vehicles were supposed to save drivers money, fewer moving parts, lower maintenance, cheaper fuel. But in reality, they've created new problems for the insurance world. EV batteries are incredibly expensive to replace, often making up 30 to 40% of the car as total value. If an EV gets into even a small crash that damages the battery casing, insurers often declare it a total loss. That means they pay out the full value of the car, even if it could be repaired. Tesla, Rivian, Lucid, and even Ford EVs are seeing skyrocketing claim costs. Some Teslas that used to be repairable now get scrapped because body shops can't access proprietary parts or software. So insurance companies have one choice: raise rates for everyone driving an EV. Add in the cost of recalibrating sensors, replacing cameras, and repairing aluminum panels, and suddenly that cheap-to-run EV is one of the most expensive cars to insure. Now here's where it gets even more interesting and frustrating. Insurance companies aren't just reacting to costs. They're reusing the crisis to boost profits. Over the last 2 years, the largest insurance companies in North America and Europe have posted record revenue. Why? Because while they claim their payouts have increased, their rate hikes have far outpaced those losses. In other words, they're charging you more, not just to stay afloat, but to make more money. Some insurers are even using algorithmic pricing, where AI sets your premium not based on your risk, but on how much the system thinks you're willing to pay. It is like surge pricing for insurance, and most drivers don't even realize it is happening. If you've seen those smart insurance offers, you know, the ones that promise to lower your rate if you let them track your driving, there is more going on than you think. Telematics devices monitor everything: your speed, acceleration, braking, cornering, and even what time of day you drive. In theory, it rewards safe driving. But in practice, it's another data goldmine for insurers. Over time, they use your habits to fine-tune pricing, and even small changes in your behavior can trigger rate increases. Drive late at night? Higher risk. Brake too hard? Higher risk. Commute through a busy area? Higher risk. This data-driven pricing model is growing fast, and it is quietly changing the industry from one based on statistics to one based on surveillance. Of course, we can't ignore the basics: inflation and supply chain issues. The cost of car parts is up 25% since 2020. Skilled auto technicians are in short supply, which drives labor costs up. Repair times are longer, and rental car prices have doubled in many areas. All of this adds up, literally. When insurance companies calculate risk, they look at what it costs to get you back on the road after an accident. And right now, that number is the highest it's ever been. Even a small fender bender that once cost $1,000 can now reach $4,000 or more. So even if you've never filed a claim, you're paying for the rising repair costs of everyone else who has. Here's where things get unfair. You'd think safe drivers would get rewarded, but that is not always the case anymore. Many insurance companies now use location-based risk algorithms. That means your premium depends more on where you live than how you drive. Live in a city with high theft rates or lots of uninsured drivers? Your rate goes up automatically, even if you've never had an accident in your life. Some insurers also track your credit score, job title, and even online behavior. People with lower credit or less stable employment often get hit with higher rates, regardless of driving history. It's a system that claims to be fair, but often punishes the people who can least afford it. Where you live, your age, and even what kind of car you drive now matter more than ever. In 2026, drivers under 25 are paying an average of 40% more than they did in 2020. Not because they were more reckless, but because their cars are newer and more expensive to repair. Urban drivers in high-traffic areas like Los Angeles, London, and Toronto face even bigger jumps because of accident frequency and theft risk. Meanwhile, rural drivers are seeing fewer choices as smaller insurance providers pull out of low-profit markets, leaving big players to dominate and set prices however they want. So how do you protect yourself from this mess? Here are the strategies that actually work in 2026. First, shop around seriously. Don't renew automatically. Different insurers now use wildly different pricing models, so switching can save hundreds. Second, bundle smart. Pair your car and home insurance, but only after checking that the combined rate really saves money. Sometimes it doesn't. Third, raise your deductible, but only if you can afford it. Moving from $500 to $1,000 can lower your premium by up to 15%. Fourth, drop unnecessary extras. Things like roadside assistance, rental coverage, or gap protection are often better handled separately. Fifth, use telematics carefully. Try a short-term trial plan first to see if it actually helps your rate before committing to long-term tracking. And finally, keep your credit strong and avoid coverage lapses. Even a single missed payment can trigger a higher risk classification that raises your rate for years. The truth is, car insurance is evolving into something completely different. By 2030, most policies will be tied directly to your vehicle's data systems. EVs, hybrids, and connected cars already stream information about speed, location, and maintenance directly to manufacturers, and soon to insurers too. We're entering an era where your premium may update monthly, based on your real-world habits. Some automakers are even launching their own insurance divisions, like Tesla Insurance and GM's OnStar Insurance, using in-car data to set rates. That could mean fairer pricing for some, but for others, it's more surveillance and less privacy. The key takeaway: understanding how this system works now is your best defense. The drivers who adapt early, who know how to shop smart, maintain clean records, and control what data they share, will win in the long run. So the next time you see your insurance renewal come in higher, don't just accept it. Call your provider, compare quotes, and question every fee. Because in 2026, knowledge is your best insurance. If you found this breakdown helpful, hit like, subscribe, and share it with someone who's tired of watching their premiums rise for no reason. This is Car Hacks and Money, helping you drive smarter, save more, and stay one step ahead of the system.